Prime Minister Justin Trudeau is crediting his government's new budget for making a hike in interest rates easier to bear. He says measures in the recently tabled budget, such as a tax-free savings account for first-time homebuyers, will help. The Bank of Canada raised its key interest rate by half a percentage point to 1% on Wednesday. That's the highest rate hike in more than 20 years. And Governor Tiff Macklem is warning the rate is going to keep rising from the current 1% level to fight inflation. Meanwhile, the Prime Minister says there isn't any one thing governments can do to help with the rising costs of living, but notes that his government is trying to implement measures that won't make the problems worse. Well, joining us now to give us deeper insight into this interest rate hike is Brendan Caldwell, Director of Caldwell Securities Limited. Sir, welcome to Forum Daily.
Nathaniel, great to be here.
So, Brendan, Bank of Canada raised the interest rates by 50 basis points on Wednesday. What does this mean for investors?
Well, it means a few things. It doesn't actually mean what I think it ought to mean, or something like that. The higher interest rates should actually make the market go down. But the market's been anticipating these higher rates for a while, and you're getting a bit of a bifurcated market going in two different directions. So stocks that are trading at very high multiples to their earnings have been under some pressure. The so-called FANG stocks, or other high-flying tech stocks whose future earnings are being discounted at increasingly higher rates, those stocks have been hurt more. Many of those stocks, including a lot of the stocks in terms of basic industrials, consumer stocks where you have a bit more pricing power, those stocks have actually been responding quite well. So the market's been going in two different directions, whereas you'd think that a hike in interest rates should be universally bad for stock markets. It hasn't been.
Interesting. So how will it affect the bond market in particular?
Well, that's a different matter. With the 10-year Canada rate at 2.7 odd, up from 1.4, so it's almost doubled since the beginning of the start of the year. It is still hard to justify rates even as low as, or as high, I suppose, as 2.7 if you've got inflation rates at 6, 7, 8%. I think the U.S. inflation rate came out at 8.5%, the longest, the highest it's been in a very long time, I think 40 years. So we are very, very short term in our fixed income holdings, holding mostly cash and very short term bonds.
Interesting. And let's move from the financial markets to a market that everyone in Canada is talking about, which is the housing market. What does a hike like this mean for Canadians with variable mortgages?
Oh, well, I think at least optically, the Liberals' policy of having some sort of home buyers plan could be helpful, although that already exists with the existing RSPs. And as I understand it, you won't be able to use both. So I don't know how extra super helpful it really is. I do think, though, that higher interest rates are going to make it far more difficult for people to buy houses. Now, it may end up meaning that housing prices take a pause or even come down. When last we saw interest rates move up dramatically, it was the 70s, early 80s, and that put a damper on housing prices. But I guess we did see it again in the late 80s, early 90s. We saw a spike in rates and housing prices cooled out. So that may be helpful. When real estate does correct, when the prices do come down, they tend to stay down for several years. So it may provide a window for first-time home buyers. I think it'll be a while before that settles out, though.
Well, housing prices may be coming down or going up, and inflation looks like it is going up and here to stay for a while. What can we do to combat inflation?
Well, I think if interest rates are going higher, I think it is incumbent upon people to endeavor to do what they can to get their debts down, or to the extent that they have floating rates on their mortgages, I would strongly recommend they move toward a fixed rate mortgage, because I do think rates are going to go higher. But inflation, these rising interest rates from the Bank of Canada and the U.S. Federal Reserve, in theory, it's supposed to cool out an overheated economy. But I'm not sure this inflation is so much demand driven because the economy is so darn hot, but rather because of the supply chain constraints due to, well, not just COVID, but the government policies surrounding COVID have made it made it more difficult to get goods and services, and the prices of these have gone up, as will happen. So I'm not sure that raising short-term rates is actually the solution. But I think for individuals, getting their debts down, or at least getting the rate on those debts fixed, I think will be key in the next little while.
Well, very interesting. Brendan Caldwell, thank you for joining us on Forum Daily today.
Thank you, Nathaniel.